Been a fantastic couple of weeks for gold, coming back into a favor at a time when markets are starting to worry about inflation once more. Now, a number of inflation indicators from a number of different countries really have shown that it's running a little hot right now, hotter than central banks had previously anticipated, and also the fear being that it's going to last longer and be more widespread than had been previously anticipated. And the reason why this has worked out well for gold is because gold is typically and has traditionally been an inflation hedge. Now, at times we haven't seen too much of this recently, but the type of inflation that we're seeing right now and the levels of inflation that we're seeing right now is making investors a little bit nervous. And on top of that, not only are we seeing high levels of inflation, we're seeing central banks that are extremely reluctant to do anything about it. They are very much clinging to the line in many cases that inflation is transitory, and the Fed is a classic case of this. The Bank of England also joined that club last week, when they announced the interest rate decision. And despite in the weeks leading up to the meeting suggesting that interest rates could rise because inflation is expected to surpass 5% this year and late this year, early next year, the committee very much voted against it. Not only did they vote against it, they strongly voted against it 7-2. So there's a bit of a credibility hit there as far as the central bank is concerned. We look at the RBA, for example, and a couple of weeks ago, we saw that they were effectively bullied off their target as far as yields are concerned on the 2024 bond. Again, then following that a few days later at the meeting, sticking to the message that interest rates won't rise until 2024. But it very much seems like the markets are guiding the central banks right now rather than the other way around. And that's not really reverberating too well in the markets. We're seeing sentiment, which had been strong on the back of an earnings season in the third quarter, which was very encouraging. But then that's paired against inflation, which is higher than markets have previously anticipated, central banks have anticipated, but central banks that are unwilling to do anything at this moment in time. Now, I don't think that will last long. I think the central bank in the US, the Federal Reserve, will see the dot plot amended next month, which will show policymakers bringing forward their interest rate hike expectations, which should alleviate some of those concerns. And I think the Bank of England may raise interest rates, for example, next month as well, following another high inflation reading today and signs that the furlough scheme didn't have that detrimental an impact on the jobs market. And I think other central banks will ultimately follow the markets eventually as well. And that may take some of the heat out of gold and its inflation hedge properties if central banks seem to be dealing with the inflation problem. But for now, what we're seeing is reticent central banks and inflation hedge gold performing very well. Now, if we look at the daily chart, as you can see on the screen here, it's rallied strongly over the last couple of weeks. It's run into a little bit of resistance around 1880. Now, we've seen that pull back off that level. That was already starting to lose momentum ahead of that 1900 test, but it actually rotated off this level on the back of yesterday's retail sales report, a very strong US retail sales report suggesting US economic strength and a strong consumer going into the holiday season, spending some of those stimulus checks. Now, this isn't necessarily inflationary in itself, which I think is why while we saw the dollar do well and we saw yields rising on the back of that, we didn't necessarily see that translate through to stronger gold, which is what we've seen over the last couple of weeks. So gold actually started to pull back, profit taking kicking in there, maybe a bit of the retail sales figure giving an excuse to lock in some profits, but already we're seeing some support. And I still think that inflationary environment is going to continue to be potentially supportive for gold. But in terms of the key levels, 1880, obviously now the first test to the upside, 1900, 1920 above there. And then we start to leapfrog into levels we've not seen in a very long time. Below, I think 1833 is key, not only because it's the 38.2 fib, so the first fib test really of this rally, but also over the course of the last few months, those rallies have been capped at 1833. Now, this seems like a very strange and specific level, but on 3, 4, 5 occasions, 1833 has capped the rallies and gold has rotated to the downside. So naturally, now that we've finally broken above here, that is going to be the first major test as far as the downside is concerned. But ultimately, it's the central banks that hold the cards here. If they start to act like they are prepared to address inflation rather than wait, cross their fingers, bury their head in the sand and do nothing, then I think we will see the edge come off gold. That doesn't necessarily mean that some central banks have to move. The Fed was only positioned to move in June, but if they start to act like they were willing to raise rates 2 or 3 times next year, and if inflation needs to be addressed with, then I think we will see some of the heat come out of gold. But right now, the reluctance of central banks combined with the high inflation readings doesn't make for a positive, optimistic investor, and that has lent itself to safe haven, inflation hedge, gold performing very well.